Hello, everyone. Art Alvarez at MortgageWorks, where we do have the answers and they're on the house. Welcome to this week's Mortgage Minute. As Jeff and I were sort of kidding around about, it's been a jubilant week in the financial markets, in particular the bond markets and the interest rate and mortgage rate markets, which we're going to touch on here in just a minute. And as you know, I'd like to start off with giving you a little bit of an update about the bond market and the interest rate market. This week, it's all about inflation data points and the Fed meetings, the last 2-day Fed meeting of the year. So that's what this week was all about. And it's now showing when you take a look at both our rate grid on our website, there's the rates right there. Jeff just pulled them up. We're now in the very low sixes for conforming loans. We're now back in the fives for FHA, VA, and 15-year conforming loans. We're getting into the low sixes for jumbo 30-year fixed. And look at the very top of this rate grid when you look at the temporary buy downs, the 3-2-1 and the 2-1. So if you're able to structure a purchase deal, or if you're a seller, if you're able to help a buyer buy your home, and you're going to use a 3-2-1 buy down as part of the transaction, you can get a conforming loan with a first year rate back to the old days of 2020 and 2021 of 3.25%. So keep that in mind. Definitely, trending in the right direction. And where this is really visible is on the 10-year bond yield chart. As you know, that's what I suggest is your best barometer for tracking mortgage rates. And this chart really looks nice this past week, given that drop in yield that you can see there. Look at that. I mean, we were up over 4.2, and now we're down to at the late today down to 3.92. So that's a direct that's direct evidence of why those mortgage rates on our rate grid are so much better than they were a week or two ago. Now, in that respect, so what happened to actually cause this kind of pretty significant improvement? Couple things. First is the CPI. That's the first inflation data point. CPI, you all know by now probably, Consumer Price Index. That's considered inflation at a retail level. Slight increase in November. But a slight decrease year over year. That's what the YOY is, year over year. Slight decrease, 3.1% from 3.2% year over year. Then the Producer Price Index, that came out the next day. It came out yesterday. Pretty much flat line for November, and an actual decrease year over year of down to 0.9 from 1.2 previously. So those were two pretty good indicators that we are past the worst of it as it relates to inflation. And so, of course, the Fed also concluded their 2 days of meeting yesterday, late morning. And, of course, after that, there's a press conference with Fed Chairman Powell. And his comments also provided lots of celebration in the markets. He did. I've got a couple of quotes here from him. We are likely at or near the peak rate for this cycle. So that's obviously a pretty strong signal. And he's also saying inflation has eased over the past year, but remains elevated. So he tried to keep that little bit of a cautious tone, like, hey, we're seeing improvement, but we're not over yet. And he's still keeping rate hikes on the table, but now suggesting it's much more likely. But given all this jubilation, like I did last week, I just want to point out, this is all good news, obviously. We want this kind of trend, but we're only back to where we were in early July. And of course, now with today's improvement going back under 4 on the 10-year yield, well, we were at that level in the high 390s in June of this year. And of course, I can recall in June, not everybody was jumping up and down about a 6% mortgage rate, but we're basically back to that level. And so, yeah, that should give us definitely something to cheer about. And I think it looks like is going to be maybe an ongoing trend. But in that respect, given what's happening, I've still got this bullet point: will buyers and sellers capitulate? We're starting to see evidence of that. I'm seeing more activity in terms of pre-qualification requests. I think we're seeing more buyers who are starting to realize we're at where we're at. We are seeing some improvement. Maybe now is a good time. And keep in mind, folks, more home prices really haven't fallen that much over the past year or so. And if we get a few more buyers getting out there, kicking some tires, looking at some homes, getting pre-qualified, just that little bit of uptick in buyer activity could put some pressure on prices because we're still lacking sufficient inventory. So keep that in mind. The other thing I want to point out is, given those buy down rates you saw in our rate grid, this is a great time to get a pretty low note rate on that 3-2-1 or 2-1 buy down, get a start rate in the threes or fours. And because this improvement in rates, I think, is going to be gradual, you'll still have that 2 to 3 year window to refinance into a lower note rate ongoing. So keep that in mind. The other good news about all this, in terms of the inflation numbers improving, the bond yields improving, and the fact that Fed did not raise the Fed funds rate again, which hasn't happened, by the way, since July. HELOC rates, they're very stable now. HELOC rates have not gone up in almost 5 months now. So though I never argue you should time the market, if you're still on the fence about a HELOC, now would be a great time to consider one, because I think we definitely have hit the peak on the rates for those. And I think with the Fed now talking about lowering the Fed funds rate maybe 2 or 3 times in 2024, you can grab that HELOC now and ride that rate decrease down, because your HELOC will adjust with that right away. So keep that in mind if you've been on the fence about a HELOC.